Hey everyone, in this video I'll be talking about APRA's new restrictions. So interest rates have effectively just risen by 50 basis points or 0.5%. What does this mean? Which suburbs are going to be most impacted? If you're an investor, you're looking to buy a property or you already have a property, you're going to want to stick around because this is the review of what the Australian Prudential Regulatory Authority just did, what it will mean for investors and owner-occupiers alike, and what it will mean for the housing market in the next 3, 6, 12, 18 months. Alright guys, so my name's PK and I help people build passive income by buying properties that give them so much passive income with data without using a buyer's agent. Guys, this channel exists to help you get ahead in Australian real estate. So if you want to get ahead in Australian real estate, hit the subscribe button, turn the notification bell on, and please give it a thumbs up so it can go to more people. So let's get into it, right? The Australian Financial Review, they released this update last night, and let's just go through it and I'll give you my comments on it. So first of all, here come the lending curbs as the regulator steps in to cool hot prices. We all knew that the Australian housing market was out of control. I always said it wasn't a bubble, it was a boom. So prices aren't going to come down, I'll tell you why, but they will continue to go up now at a slower rate. So the banking regulator's first shot in what's set to be a long fight to rein in is rampant house prices shrinks the amount people can borrow by telling lenders to raise the imaginary interest rate they expect people to be able to pay. What does this mean? So when the bank assesses you, they imagine that the actual interest rate that you're going to pay is 2.5% more than what they actually get you to pay. So if you have like a 2.5% mortgage, they've actually assessed you at 5%. These changes, what happened yesterday, the only difference is that now they're going to assess you not at 2.5% more in terms of buffer, but 3% more. Okay, that's the only difference. Before they said they will look at debt to income ratios, they'll see how much debt you have versus your income. That was all too impractical, not easy to actually implement. If you think about how many millions of households there are, so many, hundreds or thousands of mortgage brokers and all this kind of thing. So they've come in with this more blunt instrument approach. So think about it like this. Interest rates have just increased by 0.5% because for all intents and purposes, that's what's actually happened. So the way to understand that is someone approved for a 600k loan today or yesterday will, from tomorrow, I mean, theoretically tomorrow, it's going to take a couple of months for this to kick in, but from tomorrow will only be able to get a $570,000 loan. All right, so what does that mean? I mean, you think about it in context, that has diminished, if you look at the statistics, that's diminished the ability of about 5% of borrowers to get that loan. If you kind of put it in relative terms, it's diminished housing finance or it's truncated people's ability by 5%. So it's something, it's not nothing, but it's not significant. That's the key takeaway. So someone who is going to buy, let's call it a 700k property with a 600k loan, like they're still able to buy properties, right? It's just not 700. Maybe they need to look at a $650,000 property. So I'll get to which exact suburbs this is going to impact very shortly. It won't actually be enough to stem the boom that threatens to price another generation out of their own home. So even the people that are making this change are saying this isn't actually going to slow down house prices. This is actually not going to take the boom away. This doesn't mean that there's going to be a price crumble. So the key, or one of the key takeaways I want you guys to take away from this is, if you were sitting on the sidelines in COVID thinking house prices are going to collapse, and now you regret it, and now you're thinking the same, that now interest rates have gone up, borrowing has become more difficult and houses prices are going to collapse, you're going to regret it again in 12 months time and in 15 months time, because actually even those who are making these policy changes, they themselves are saying that it's not going to actually bring down prices. The rate of growth will taper, but it will still grow. Okay guys, so if you're getting value out of this, please subscribe, hit the notification bell. Let's keep going to the exact suburbs in a second. All right, so This is not a one-shot exercise. They themselves are saying that this will not be enough to curb house prices. All right, so what I'm going to go now is, before we get to the top 20 most leveraged postcodes, I want to really make this point that the research shows that rich and otherwise households across the country are mortgaged to the eyeballs. Okay, that's what the research says. But let's see what they're actually talking about. In Melbourne's Toorak, more than 7 in 10 households have borrowed 5 times their income or more. So before, we were talking about how APRA was going to clamp down on a debt to income ratio, people who borrow 6 times or more versus their annual income. So if they're making Toorak, so if they're making $100,000 per annum, they've borrowed more than $600,000. But the point this is making is it's more the rich, here in Toorak. This is not $1 million suburb. Toorak is a $2, $3, $4, $5 million suburb. It's these areas that are mostly going to be impacted. So if you're in Adelaide, or you've invested in Adelaide, if you're in Brisbane, if you're invested in Brisbane, if you're in Perth, you're invested in Perth, or if you're in the regions or invested in the regions, just take a breath, all right? Just chill. This interest rate increase is going to hit some suburbs hard, mostly Melbourne and Sydney. All right. So what this is also saying is that's almost as much in terms of that ratio of debt to income as Sydney's working class Baulkham Hills and Beaumont Hills. Baulkham Hills, Beaumont Hills, both, high $1 million. It used to not be that way. It used to be like around $800,000-$900,000. Now it's $1.5-2 million, or even higher in some cases. The people who have bought there are not like millionaires. They're mostly just people on $100,000-$200,000 household income, and now they've got this debt of more than 6 times their household income. That is who will be impacted. Not investors who are just buying sub 500k properties and getting rent, which calculates, or which incorporates, or which is part of the income ratio, the debt to income ratio. Rent is included in that. Well, that's not who it's going to affect. It's going to impact owner-occupiers, upgraders, and first home buyers who don't have that rental income, only have their PAYG or business income, and have got too much of a high mortgage. So like we said, Melbourne, Toorak, Sydney, Baulkham Hills, and around. These are the most leveraged postcodes. This is not where we're investing anyway, guys, if you want positive cash flow. Economists say it will only affect those at the margins, right? So only those who are perhaps too leveraged because they bought these $1 million, $2, $3 million properties. And most of the factors that have driven prices to their steepest growth in more than 30 years remain firmly in place, right? So I'm not a property spruiker who's just saying buy, regardless of what's going on. This is clearly going to cool down the rate of growth in prices. There's no doubt about it. And APRA is going to be vigilant like a hawk. But what this is not going to do is bring prices down all of a sudden, even probably not in these types of, rich, quote unquote, household neighborhoods. In these neighborhoods, I'm always said, sustainable growth just wasn't there in Sydney, Melbourne, and now that's kind of nailed in the coffin. You shouldn't have been buying there anyway, but even those areas are unlikely to experience a 20-30% fall. They might experience a slight fall, or they might just plateau out, or the rate of growth may be very shallow, but it's not going to mean that the property market is crashing down. Whilst we don't really believe bank economists, at least the CBA guy, Gareth Aird, is sticking with his 7% price growth projection for 2022. Remember, that's market-wide, national-wide. Within that, there's markets within markets. Some that will grow by 20, 30, 40%, others that will go a little bit backwards. But let's not hang our hats on what Gareth is saying, because last year he said that prices might fall 30%. All right, and the Reserve Bank is still worried about house prices, and yet again, it said that it expects interest rates to be nailed to the floor at 0.1% until 2024. So this APRA change, this policy change, is an artificial change. It's not actually interest rates rising, but for all intents and purposes, the banks are now going to assess you at a 0.5% higher interest rate. Theoretically, that's not what you're actually paying, but that's just what they assess you at. So let's see which suburbs are going to feel the pain. All right. So these are the most leveraged postcode. So that's the postcode, that's a debt to high debt to income household, huge debt. Suburbs, state, median house prices, 12-month price. So Beaumont Hills, I mean, the data was fantastic, and it still is fantastic for Beaumont Hills. I still hang my hat that prices will continue to increase, even though it's leveraged to the hilt. The next one is Balcombe Hills. Once again, these are all 1.3, 1.3. Kingsford in New South Wales, 2.3. Wheelers Hill, I don't know all these suburbs, by the way, 1.2. Canterbury, 3 mil. Regent's Park in New South Wales. I know so many people, so many of you that might be listening that have made $200,000 in a place like Regent's Park in the last, 12 months or something like that. But check it out. It's over leveraged. It is the most susceptible to these types of areas. So if you're in Sydney, Melbourne, guys, I keep encouraging you, please, please, please think twice, 3 times, 4 times, 5 times before investing your hard-earned money in Sydney, Melbourne when it comes to investment property. Buy positive cash flow elsewhere. I mean, you can have a look at this by yourself, but scanning down, apart from WA, where this suburb is only 580, and down in Sydney, where it's, kind of around the 600s, or, I don't know what's going on here with Ellenbrook down at 400. I don't know what people are doing over there. They might be earning almost nothing if the leverage ratio is so high and the prices are so low. But apart from those few outliers, the parts of the market that are most going to be impacted are your top end of town, $1, $2, $3 million type suburbs. If you're buying sub 500k positive cash flow properties, as I know my clients do, I've done, so many of you do, just chill. This is not really going to have that much of an impact. And by the way, this new policy does not impact non-deposit taking institutions. It only impacts ADIs, authorized deposit taking institutions, so big 4 banks and places like that. If you're going to a third tier lender, Resimac, First Mac, Pepper Money, all these ones, they don't have to follow what the APRA guidelines are. So if you're on the edge of your borrowing capacity, you want to buy more investment properties, you can do so. Get your mortgage broker to take you through these third tier lenders. They're not really any more high risk. You're not giving them your money, they're giving you their money. That is what really you need to be doing. And the debt to income ratio is not something they will look at. These new policies is not something they need to actually implement. APRA only has a reign over the bigger banks, the ADIs. So there's so much opportunity. Guys, take away from this video, property prices continue to go up. If you're on the sidelines waiting for a cool down, if you're thinking that today's not the best time to be buying property, that next year is going to present better opportunities, I'm outspoken, hate it or love it. Property prices are going to keep going up. I hang my reputation on that. I have nothing to gain out of this. I'll equally, very happily say in a year's time or 2 years' time that now property prices are going to have a correction. They're going to have a correction at some point. This is not the time. Yes, this will cool down some markets, not all markets. Guys, get ahead in Australian real estate. I'll leave the links below that you can step up your education. My Facebook group with more than 10,000 people, my podcast, my website as well if you really want to step things up. But the main takeaway, as always, guys, the most important real estate is the 6 inches between your ears. So become educated, become educated, become educated. If you've watched this video so far, thank you. Hit the subscribe button, turn the notification bell on, and tell me, are you buying property? Leave a yes below. My name's UK. Catch you later.